Welcome to Dr. Fred Markets. This is not financial advice. Every day, the world of finance, crypto, and artificial intelligence moves fast, really fast, and staying informed is the only way to stay ahead. That's exactly what we do here, together. Let's get into today's video.
Your crypto bags are secretly funding 80-year-olds' beach houses. Signal 1, the S&P 500 is up a lazy 0.25% today. But strip out the Nvidias and the rest of the circus, and you're basically owning a national retirement plan for boomers who bought index funds before the internet. You think you own growth. In reality, you're a liquidity hose aimed straight at people 30 to 40 years older than you. They bought cheap, they drip sold high, and every time your paycheck auto hits that index ETF, you're buying their exit. Signal 2, housing and medical costs, boomer-heavy expenses, became the unofficial core CPI, too big to fail in political terms. Instead of letting prices reset in 2008, the Fed nuked interest rates to zero, then did it again in 2020, turning your future into a bond their generation already clipped the coupons on. Low rates inflated assets boomers already owned: houses, stocks, bonds. You got the student debt, they got the compound interest. Signal 3, the FIRE movement, financial independence, retire early, sold you the fantasy that you can copy boomer outcomes with boomer tools in a post-boomer market. You read blogs saying save 50% of income, buy index funds, retire at 35, while real wages stagnated and asset prices levitated on central bank fumes. You were told to chase a 4% withdrawal rule in a world where the withdrawal rule was written by people who never paid $2,000 for a shoebox apartment. Here's the cliffhanger. The playbook that worked from 1980 to 2020 is dead for you, but you're still being told to worship it like a religious text. Let's stitch this together. From 1980 onward, boomers rode a once-in-history combo: falling interest rates, rising globalization, exploding corporate margins, and dirt-cheap assets. An index fund was a cheat code: own everything, pay nothing, ride the tide. Every recession, cut rates. Every crisis, bailout. Your generation inherited the price, not the upside. Your S&P contribution at $756 per share is not the same game as theirs at $15. They got decades of multiple expansion, PE ratios rising, on top of earnings growth. You're buying the mature, expensive end product and hoping it behaves like the scrappy underdog it once was. That's not investing like Buffett. That's buying the after party at bottle service prices. This is where lifestyle enters the chat. Financial independence is not dead, but the boomer version is. They did. Buy house, stay at one job, load up indexes, retire at 60 with a pension and a golf habit. You get unstable job markets, inflated housing, and a stock market wired for buybacks and financial engineering, not broad-based prosperity.
Does what you just heard make you want to dig deeper? Good, because that curiosity is exactly what brought you here, and the second part is going to take it further. Let's go.
So what works now? First, you stop worshiping retire by 35 blogs written in 2012 when everything was cheaper and volatility was subsidized. Second, you accept that your path to freedom is more offense, less passive daydreaming. Higher income, higher skill, higher leverage, not just higher savings rates stuffed into old vehicles. Concrete lesson you didn't get on TikTok. The boomer FIRE engine was built on 3 gears. 1. Cheap entry prices into broad markets. 2. Long, one-directional rate cuts. 3. Social structures that quietly subsidize them. Pensions, cheaper education, less healthcare chaos. You don't have those gears. Your edge is different. You can stack multiple income streams fast. Remote work, side hustles, online leverage. You can arbitrage geography, move where your income buys freedom instead of vibes. You can own assets boomers ignored. Digital skills, niche businesses, and yes, stocks, but actually chosen, not worshipped. Here's the mechanism. If your main move is max my index fund and pray, you are the greater fool in a slow-motion wealth transfer. You buy at structurally higher valuations, they sell to fund retirement. Index funds still work long-term, but not as a magic spell that replaces thinking. Your freedom will come from increasing the size of the pie you feed into investments, not squeezing another 0.3% yield from the same tired products. So what do you do, starting this week? 1. Audit your time like a CFO. If you're spending more time picking ETFs than upgrading your income skills, you're playing the wrong game. The market rewards capital. Your life rewards skills first, capital second. 2. Build a freedom floor, not a fake retirement number. Calculate what it takes to cover your boring bills. 2 gar, 3 4 cal a month. Aim to cover that with diversified, semi-passive income, a small online business, a specialized service, maybe later, real estate or dividends. Financial independence starts when your basic life is funded by assets and systems, not when a spreadsheet says $2 million at 4%. 3. Use the market as a partner, not a god. Auto-invest in broad indexes if you want, but treat it as a base layer, not the whole religion. Layer on targeted bets aligned with your skills and circle of competence. And remember, your biggest compounding asset for the next 10 to 20 years is not the S&P 500. It's your earning power. This is not financial advice, but here's the truth. Boomers had a tailwind you will never see. You do not beat that by nostalgia cosplaying their strategy. You beat it by building an income engine they never needed. If you learned one thing today, it's this. Your FIRE plan is a lifestyle design problem first, an investing problem second. Subscribe, come back tomorrow, and we'll keep ripping apart the scripts that keep you broke. This is not financial advice. If you enjoyed this video, please subscribe to the channel and check the links in the first comment below.
That's a wrap for today on Dr. Fred Markets. I hope this gave you something to think about, a new angle, a clearer picture, a better question to ask. Remember, this is not financial advice. Do your own research, always. If this video added value to your day, subscribe. It's free, it takes 2 seconds, and it's the best way to support this work and keep it free for everyone. You'll also find every video as a full article on the blog, drfredmarkets.com, and the newsletter is in the bio. I'm Dr. Fred Markets. See you in the next one.